The following segment is a paid commercial program by Heritage Bank, member FDIC. It's time for Ask the Expert on News Talk 1340 and 96.3 FM, KWLM.
Thanks for joining us. Chris Vraa sitting in with us from Heritage Bank. Chris, good morning.
Good morning. Thanks for having me.
Yeah, so tell us quickly, just to recap, what's your title and what does that mean kind of for people?
I am called an MLO, which stands for Mortgage Loan Originator. So I'm basically a loan officer that helps people get into homes.
Oh, wow. You're somebody that people love to see, and then when they're finished with you, they have a new home. So
and they have a new home, yeah.
Pretty exciting.
And hope they come back when they go to their next home and so on and so on.
Yeah, that's got to be really a fun part of the gig for you.
It is, and then also working with people that you've worked with in the beginning, and now you're financing their kids' homes and so forth. So that has been really fun.
So let's dig in a little deeper. What's the difference between a pre-qualification and a pre-approval? And does it matter when you're buying a home?
It sure does matter. A pre-qualification is kind of good for the early stages of home shopping. There's usually no hard credit check. It's based on what you say that you make and say that you have for debts, and I can do some calculations and say this looks approximately about what you would qualify for. It's a very informal estimate. My daughter is in that stage. You know, she's looking to buy a home, but maybe not for a year or two, but she kind of wants to start looking at the market to see what it could get her, but how much can she afford? So we just did some informal calculations. But if you're serious about buying a home, then you really need to go to the pre-approval status, which is an actual formal offer from the lender. It's based on verified income, verified credit. It shows the agent that you are serious. It shows the home seller that you are serious about purchasing a home. We verify your income with pay stubs and W-2s, tax returns if you're self-employed. We do verifications of employment with your employer. We pull your credit, so there is a hard credit. But it gives you a confidence when you go in to make an offer on a home. And then also if you're negotiating on the home, it gives you that confidence. And most likely, if you're working with a realtor, if you are not pre-approved, they are going to send you to get pre-approved prior to them showing you home so that they know that we're in the ballpark of what we're looking at. And a pre-approval is usually good for 4 months. And the reason that is because your credit report typically expires in 4 months. And then after that, we can certainly pull a new credit report and get updated documents to keep your pre-approval going. But if you're serious about buying a home, pre-approval is where you need to be versus the pre-qualification.
Yeah, boy, it makes everything so much smoother, and going and knowing exactly where you need to be or under is certainly a good thing when buying a home.
Well, true. I can tell people many times, tell them what they're pre-approved for, and they're like, no way. I do not want to have that kind of house payment. And so you always ask them, what are you comfortable with spending on a home? You know, talk about what you are comfortable. And then knowing that they can go down 200, go up 200, if they just know if they found that perfect home, that if it was worth it for them, they could qualify for $200 more a month maybe. They know they can, but they weren't comfortable with it. But given it's a perfect home, they're willing to take that. But there's some people that are right on the edge too, that there's just no way you can't qualify for any more than this. And they have to take that down a notch if they find something.
Sure.
So everybody's in a different boat, and that's why you have to find a good loan officer that works with you with the loan, with the numbers, and really gets to know what your feelings are on and what you feel like you can afford.
So you're getting ready to come in and get pre-approved or pre-qualified as you're still beginning your process to look for a house. What kind of documentation should somebody have when they come to see you?
Right. Well, as pre-qualification, that's pretty quick because that's just word of mouth. Things that you're telling me, I'm not verifying them. So that can be done pretty quickly. And but if you're going to go for the pre-approval stage, we are going to need verification documents. And I will say documentation is the key. If you're going to buy a home, people out there that have worked with me, worked with any loan officer, you're probably going, wow, they really have to document the heck out of this. And you do. Everything is documented. So we would start with 2 years W-2s, 2 months or two pay stubs, and driver's license, 2 months bank statements. If you're self-employed, you are not receiving a pay stub. The way you prove your income is through the tax return that you file. So then we would need tax returns. If you already own a home, we would need a current mortgage statement and so forth. And as we go through the process, we keep updating these as we go. Many things do change. There's many times employment might change during the time that we're looking. And that's a commonly asked question is, I have found a job that I can make more money in. Can I change jobs during this pre-approval process? And yes, you can. We are not here to tell you that you can't better yourself, at this time. But it's always a good question to ask, because if you're going to go from employed with a W-2 wage to self-employed, that is going to be something that will delay your home buying. Because if you're self-employed, we have no history of the income that you're making. And we're going to want a 2-year history. So you will have to wait 2 years if you initially become self-employed right during the pre-approval process. But if you're going to go from a W-2 wage to another W-2 wage job, that is something that we can do. We can easily do. Most of the time, they'll ask for you to have at least one pay stub on your new job before you close the loan. But documentation is a key on the pre-approval. Pre-qualification is just more word of mouth.
Sure. So have your documents in order and get to know. And like you said, sometimes people are really surprised by how much they might pre-qualify for. Where do you recommend where they should be with the size of their mortgage compared to their income? Is there a percentage, a formula that you guys use?
It's people that make a lot more money, if you say you can be at 45% of your gross monthly income, that's going to be a lot more comfortable for people that make a lot more money. They'll have a lot more disposable income. But if you're in, the mid-range and 45% of your income is going to feel a lot more tight. But also it varies upon product. So the products for mortgage, you're looking at doing a VA loan or a rural development loan, an FHA loan, or a conventional. You usually are in those 4 products. And underneath all of those products, you can do a first-time home buyer. And all of those have the ratios, the debt-to-income ratios that they allow. Some are more generous than others. Some have 2 ratios, a housing and a max ratio. Some just have 1 maximum ratio. So depending on the product, and that's why when you come into your lender and bring in those documents, we can look at everything and determine what is the best product for you, given your situation.
Yeah, that's terrific. So you talk with them and see what they're comfortable with and kind of lay it out so they know specifically, well, I've got these other bills, so my mortgage, I feel more comfortable here or there. And certainly the higher the income, the little easier it is to have a higher percentage of your gross.
It is true.
Yeah, going toward that. Explain what earnest money is and how it can play a role.
Well, earnest money is a good faith deposit made by a buyer to show that they are serious about purchasing a home. So if you're going to put in an offer on a home, you submit earnest money with this, and it's offered once your purchase agreement is accepted and before the closing happens. It's typically 1% to 3% of the purchase price. It just shows that you are making a good faith offer. And a commonly asked question is, where does that earnest money go for me once I put that down? And it goes directly towards your down payment or your closing costs. But if you're in a multiple offer situation and you want to show that you're a strong borrower and you can put down, let's say $5,000 on a $300,000 home or so forth for earnest money, and most other people are putting $500 to $1,000, your offer stands out. It just is a good faith deposit, and it shows how serious you are.
Yeah, it indicates to the seller that maybe your terms would be better than some of the other buyers might be.
It will stand out on a purchase agreement if you put down a very large sum of earnest money.
Yeah, that's terrific. Different loan programs. You mentioned a couple already, VA, FHA, conventional. Who might benefit? Do you find a certain a borrower kind of veers toward a certain product?
Yes, I do. I mean, I think that's why it's so important when people will call in right away and say, well, I want to qualify for an FHA loan. And you can ask, well, why are you geared toward FHA? Because I like to see the whole picture and then advise them on the different products and one that might fit them better than the other. Obviously, if you are not a veteran, you are not going to get a VA loan. You have to be a veteran to get a VA loan. And the one nice thing about a VA loan is it is 0% down payment. You have the option to put 0% down. The other thing that's unique about a VA loan, though, is it does have a funding fee. The VA charges a funding fee. So that's just charged right on top of your loan. And if you're a first-time user on your VA benefit, that is going to be at 2.15% of your loan. So if you're buying a $300,000 home, you're going to have $6,600 put right on top of your loan just for doing VA.
I see.
If you are a disabled vet, that could be waived. But if you are not disabled, that goes right on top of your loan. So already you're starting out at a $306,000 loan as opposed to another product where you would not have that funding fee. Now, if you need that 0%, you don't have a lot of money to put down, that might be a good option for you. But many veterans find that if they have down payment, a conventional loan might be a better option. So just because you're a veteran doesn't mean you should just always do the VA loan. FHA loan is 3.5% down, but it's kind of an expensive product because it has upfront mortgage insurance and mortgage insurance due monthly. The niche on FHA loans is probably more your lower credit score borrowers, maybe those that have to go higher with their debt to income. So a lot of times that might be a good first-time homebuyer product when your credit is just starting to be built and so forth. And then rural development. We do have rural development in Wilmer because it's geared towards rural cities that are usually under 50,000 in population. And that can be a 0% down payment program, but that also has an upfront fee of 1% and then PMI monthly. So, and then your conventional loans, all the three mentioned, VA, FHA, and RD, they're all a little bit stricter on your property. So if you're offering on a property, if you're going to do one of those types of loans, your property is going to have to qualify for that. If you're going conventional, it's a little bit more flexible on the property standards, and it is looked probably more highly upon when they're getting offered that by the seller. The seller looks more highly upon a conventional because it's just is easier for the property to get qualified.
Sure.
So with conventional loans, you can go up to, as little as 3% down in some cases. Rural development, I would like to say that does have, it's income-based. So in this area, if you earn $121,900 or less on a 1 to 4 family home, you would be eligible for that product.
Okay.
If you have more than 4 people in your household, that income limit is $160,950.
I see. All right. How about first-time home buyers? Where do you tend to find yourself sending them?
So a first-time home buyer is defined as a person that has not owned a home in 3 years.
Okay.
So you can be a first-time home buyer if you owned a home 10 years ago.
Okay.
So that is something that people don't understand, too. But all those loans I just talked about, the VA, the FHA, the rural development, and the conventional, we can do any one of those loans under the umbrella of first-time home buyers. But that is also income-based. So in a family of 2, your income could be no more than $116,900. 3 plus or more in your family, it goes to $134,400. So you have to earn under that to be able to be eligible for those. Sometimes it's still not the best product for you, which is why it's good to come to a loan officer to ask. Sometimes the interest rate is higher on a first-time home buyer, but it does give you access to no down payment assistance loans. So if you can go first-time home buyer, you may be eligible for a down payment assistance loan.
Great. So first-time home buyers, are you still seeing some of those, hopefully?
Oh, yeah. Yes, we are.
Great. That's great. Pros and cons of each of the major types.
Well, like I said, the down payments can vary. The debt to incomes can be higher or lower on certain products. And if you're a veteran or if you are a new home buyer and FHA suits you, there's just a niche for each product. And that's why you have to find a loan officer that you feel comfortable with and find out which is the best option for you.
I bet you have to do some education too. There's some teaching that goes along, in particular with first-time home buyers. I'm sure they're coming in and kind of looking at you going, help?
Yep.
This
and
is
they
complicated.
Do. Yep.
Yeah.
And so you just start from the very basics. And even on the first-time homebuyers, one of the qualifications for the program is that they do have to take a homebuyer education course. It's online, and it takes probably 30 to 40 minutes, and it's free. And then they have to provide a certificate at the end for their file to show that they have taken it.
Okay.
And I've heard that it's good. I mean, it is good, and it's all online. So they used to have to go to a actual presentation, and be present at a class.
Okay.
But now it's all online.
Yeah.
So, yeah, it's fun to work with those first-time home buyers, and you just hope that you get them back when you're doing your second home.
Yeah. Any final words, advice for people if they're deciding to get into the home buyer's market right now?
Well, if you're looking, even like I mentioned my daughter, I mean, find out kind of where your credit score is at and if it can be improved. I mean, if you're going to want to be, for sure, for the first-time home buyer products at a 640 or better. The better your credit score, the more options you are going to have, the better options you're going to have. Start saving. Put money away for closing costs, down payment. It's expensive to get into a home. Even if you get into a 0% down payment program, even just moving is expensive. Keep your debt manageable. Don't be going out and buying large purchases right before you're going to try and borrow for a home. And then find a lender that makes you comfortable and ask questions.
Yeah.
And no question is silly.
Yeah, that's right. Chris, thanks so much. Have a great day.
Thank you. You too, Todd.
Chris Vraa joining us this morning from Heritage Bank. HeritageBankNA.com is the website.